Sometimes we get so wrapped up in doing stock research and get so focused in on individual companies that we forget to take a step back and review the state of our portfolios as a whole. This has certainly been the case for me lately, and so in this video, we're going to go through my entire portfolio, and as objectively as I can, I'm going to give my portfolio an honest review. I think it's important to share these thoughts on how I can do better and build a more streamlined portfolio, and hopefully by doing so, there will be some takeaways that you can apply to your own portfolio. Anyway, starting off with a little bit of my investing background, I started doing this stuff about 3.5 years ago, and I started making videos on investing about 2.5 years ago in October 2020. And when I first got started, I wasn't 100% into dividend investing. I actually had a decent amount of growth stocks, but I started getting deeper into watching guys like PPC Ian, The Dream Green Show, JJ Buckner, and my man Russ over on the Dapper Dividends channel, and a handful of other creators who helped me essentially see the light, and engulfing myself in their videos put me 100% on the path to dividend investing. Prior to learning about all this stuff on YouTube, I came into this with zero experience, so I essentially had to learn the ropes from scratch. And I didn't go to school for this stuff, but in hindsight, considering how much I love investing now, it's a big part of my life, I wish I had pursued it for my formal education when I was going to college. I think that would have been a really good thing for me. But anyway, on that note, I want to talk to you real quick about today's video sponsor, Southern New Hampshire University. Now, as someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said I'd never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value. You'll learn to apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio. You'll learn to utilize the rules and regulations for financial accounting and reporting in a global economy. You'll learn to generate financial records and financial statements for users in accordance with governing rules and regulations. And you'll learn how to analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on a call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryne or find the link in the description to see what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryne. Anyway, now moving on and getting into my portfolio, we are looking at my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to it in the description of this video. I hope you check it out because I think you'll like it. But I actually have two different portfolios. This is my main account on Charles Schwab that is currently valued at about $45,800 and is bringing in $2,072 of annual dividend income. This is my actively managed portfolio, and it's mainly comprised of individual stocks, but all of these are hand selected by me. And then my other portfolio here is my Roth IRA that I keep on M1 Finance, and this is valued at about $4,300. I started this last year, and it's currently bringing in about $125 of annual dividend income. And as you can see, this portfolio contains 4 different ETFs. This is much more passive than my main taxable account, and most of this portfolio is divvied up into SCHD and VU, which I think make up about 80% of the total portfolio. But anyway, if we combine the value of these two portfolios, that brings me at just over $50,000, which I think is the first time I've ever seen this. Cool little milestone. And my annual dividend income is just a few shekels short of $2,200, and I'm bringing in almost $185 every single month. Pretty cool. And now, before we get into all of the individual holdings in this portfolio, I want to give you an idea of how this portfolio is diversified between, low and high yielding stocks, and also between low and high dividend growth stocks. And starting here with how it's diversified by yield, we can see that my portfolio is pretty heavily skewed towards higher yielding dividend stocks, and I personally consider anything above 4% to be high yielding, and there's 12 of those in my portfolio. Then I have almost an equal amount that are pretty mid-range between 2 and 4%, and then I've got 4 of what I would consider lower yielding stocks between 0 and 2%. And going back to my high yielders, these are the top 5 highest yielding stocks in my portfolio. ORCC is right there at the top with a yield just under 10%. We've got Altria Group in second place yielding 8.2%, JEPI in third place yielding 8%, and then we've got EPD and Verizon in fourth and fifth place, both yielding in the mid 7% range. So I have a decent selection of high yielding stocks. And then moving on to the dividend growth department, interestingly enough, my portfolio is more heavily skewed towards lower dividend growth stocks. The great majority of the stocks in my portfolio have dividend growth CAGRs that are below 5%, which is on the lower end, 10% for sure. Then I have 8 that are what I would consider pretty mid-range between 5 and 10%, and then 6 what I would consider to be high growth dividend stocks that have dividend growth CAGRs over 10%. And taking a look at the top 5 dividend growth stocks in my portfolio, Lowe's is sitting at the top with a CAGR of near 21%, and Lowe's is one of the bigger positions in my portfolio. It's one of my top 5 biggest positions. Then we have SCHD there in second place with a CAGR of about 15.5%, and SCHD is starting to become a bigger position of mine as well. We've got Snap-on in third place with a dividend growth CAGR about 14.6%, looking pretty good. We have AbbVie about 14.5%, and then Starbucks, which is the biggest position in my portfolio, has a dividend growth CAGR of about 12.5%. And if we briefly scan all of the holdings in my portfolio using the dividendtracker.com, which yes, once again, you can use this for free as well, and there is a link to it in the description. But here we can see we've got a little bit of everything. We've got some bigger blue chip companies like Apple, we've got Chevron, we've got Starbucks if we keep scrolling down. I have a handful of dividend kings like Johnson & Johnson, Coca-Cola, Lowe's, 3M, and Procter & Gamble. And there's also some strictly income plays in here like EPD, Main Street Capital Corporation, JEPI, Owl Rock Capital Corporation. So like I said, we have kind of a wide variety of everything in this portfolio. And if we categorize this by best performers, we've got Chevron at the top, which I'm up nearly 68% with this position, so doing really well. Apple's in second place, I'm up 42%, which is interesting because this is the most recent addition to my portfolio. I started buying it back in December, I think right before Christmas, and it's really taken off. Snap-on's in third place. This has been another really good performer for me, up nearly 30%. AbbVie up nearly 20%. It's kind of come down recently, so I used to have a bigger gain than I do right now, but it's all good. And then Coca-Cola is actually my 5th best performer, interestingly enough. I'm up 18%. And doing the same thing, looking at my worst performers, 3M is by far my worst performer. I'm down nearly 40% with 3M right now. It's really not looking good. Both of the telecom companies, Verizon and AT&T, I'm down quite a bit, 30.5% and 27% respectively. KRC, unfortunately, is in my top 5 worst performers. I'm down 20%, but this is getting better. It's kind of experiencing a run-up recently. And then Intel is starting to look a lot better. I'm down almost 20% with this position, but it used to be a lot worse. And so that's my portfolio in a nutshell, guys. And if I'm being completely honest with myself, I'm probably too over-diversified. I probably have too many positions, and there's definitely some room for consolidation here. Like, for example, I probably don't need to have both AT&T and Verizon. I probably don't need to have both Main Street Capital Corporation and Owl Rock Capital Corporation, 2 different BDCs, and I probably would survive without JEPI in my portfolio. And as time goes on, the ETFs in my Roth IRA, namely SCHD and VU, will become bigger portions of my overall portfolio, which further mitigates the need to have an overabundance of different stocks. Plus, based on my long-ish time horizon, I think I realistically will probably start drawing dividends somewhere in the next 10 to 20 years, probably towards the longer end of that range. But based on that, it would make sense to consolidate some of the positions in my portfolio, especially some of the higher yielding ones, and put more emphasis on the strong dividend growth stocks that I have, like Lowe's or Snap-on or even Starbucks. And that's not to say that I would completely eliminate all of the high yielding stocks in my portfolio, because I do think they have their place, and I do like to keep somewhat of a balance between high growth and high yield. But with 12 different positions yielding over 4%, there's definitely room to consolidate and get rid of some of those, and I could do it in a way that wouldn't dramatically reduce my current dividend income. And this brings me to the next part of the portfolio review, which I like to call the perfect 10. So if I had to narrow this 27 stock portfolio down to just the perfect 10 positions, which ones would make the cut? And these are them, guys. We've got EPD, Johnson & Johnson, Lowe's, Altria Group, Realty Income, Procter & Gamble, Starbucks, SCHD, Snap-on, and VU. And I think this gives me the best of all worlds. I got some high yielders, I've got some high growth dividend stocks, I'm well diversified because I've got those ETFs in there. And if we compare this to my actual top 10 highest weighted stocks in my portfolio, it's pretty close. 6 out of 10 are in my perfect 10, and SCHD, which is in the number 11 spot just based on weighting, will make its way in there pretty soon. But having said all this, what does this mean? Am I gonna go sell 17 positions and just rock with my perfect 10 portfolio moving forward? I mean, not exactly, but over time, I would like to slowly but surely start consolidating out of some of these positions. I think in the Roth IRA, I could get rid of 2 of the ETFs and just go with SCHD and VU. I think that would be fine. And then in my active main portfolio, I think I could bring the number of holdings realistically down from 23 to 20, and then maybe even down to 17 and 18, and keep doing that until I find the sweet spot. I'll tell you what though, it's hard to sell out of stocks, especially some of these high yielding ones that are bringing in that awesome cash flow, like this one right over here that I've actually been buying more of lately. This stock is currently yielding near 10%, and I've actually been adding some more shares to my own portfolio, which I'll tell you all about in the video. So click right over here to check it out, and I'll see you in the next one.